Now remember, this is my wild guess. Even a Nobel Prize winner, right, it also cannot correctly guess whether will the stock market collapse or not. But let's look at it from a fun perspective and from a learning perspective. Now, if I'm wrong, then I predict a stock market crash is okay because the share price will go up, so I'm good. But if I guess it correctly, guess, if I guess it correctly and the share price collapse, then I will WhatsApp all of you. So that it becomes a second opportunity. Now remember, just now I already showed you this point, 2003, it collapsed to 2002. Very quickly, within 6 months, it recovered higher than the pre-COVID-19, even though right now we are still in COVID-19. Now, I'm going to introduce to you a ratio called Shiller ratio. And based on security analysis, PE ratio, you want, as a blunt instrument, right, you want it to be less than what? 60. So right now, we are not talking about PE ratio per se, but we are talking about Shiller PE ratio. So now the question is, what is Shiller PE ratio? Hi, this is Cayden. Remember to click on the subscribe button and turn on the notification to be notified of our future training videos. So the Shiller PE ratio is good to gauge about a lump sum of company, not individual company. PE ratio is for a good individual, company A, company B, company C. But here is you want to have a feel of the overall market. So you want to use this thing called a Shiller PE ratio. So it's good to gauge the market valuation at a certain point in time, now, yesterday, future, or whatsoever. Now, so the key thing is, if you use PE ratio, not the Shiller PE ratio, right, is there is a problem. There's a problem is if the company is cyclical, such as a semiconductor company, right? So there will be time when the PE is high, sometimes PE will be low. So it's a bit unpredictable, a bit inaccurate. So what happened is, one day, this guy called Professor Robert Bob Shiller, who is a very famous Nobel Prize economist, right, who is teaching in Yale University, one of the top universities in the world. He came up with a ratio called Shiller P ratio, which is named after him, right? Because Shiller, correct? So what is this Shiller PE ratio? Hang on, after I flash this, you take a photo, okay? So this Shiller PE ratio, the numerator, right, they still take the price per share, except that right now the E, right, the earnings per share, is he take this earnings per share over the last 10 years. Not the most recent year, not the most recent quarter. It's over the last 10 years. So over the last 10 years, so that it covers the up and down, the entire business cycle. So that it's more normalized, okay, more average, more accurate, okay, that reflects the past. Yeah. So he will take the price per share divided by the inflation adjusted, still inflation adjusted, average of the last 10 years of earnings. Yeah. So that when you take this Shiller PE ratio and apply to the S&P 500, which talks about 500 companies, right, then you have a good gauge whether these 500 companies, are they predominantly as a whole, are they predominantly overvalued, fair value, or undervalued? Yeah, so you apply to S&P 500, right? So in short, right, you know, previously we talked about PE, you want to be less than 16. Now, so what does it mean? High PE is good or low PE is good? Low PE. So the same concept applies to Shiller PE. Yeah, low Shiller PE is good. Low Shiller PE is good. But when we say if low PE, Shiller PE is good, then high. I mean, how bad is high, right? How bad is high? And what is high got something to do with a double dip or a crash. Now, some of you may know about this October 1929, the Great Depression. So in other words, the depression is worse than recession. And something happened before October 1929. So what is the something that happened before October 1929? Now, this September 1929, which is a month before the crash, right? A month before the crash, what happened to the Shiller PE ratio? It went up or went down? It went up, right? And up is a good thing or a bad thing? It's a bad thing. So do you see? This one, it appears like a symptom. It's like before you fall sick, maybe you got fever, maybe you got cough. You know, something like that. So the interesting thing is, can Shiller PE ratio be used like a symptom indicator, a sickness indicator? Ready? Yeah. So you see, it took place, crash, the Shiller PE ratio shoot up. Let's look at more data and see whether are there any relationship. Now, .com. The .com bubble crashed on the early October 2002. So let's check before this October 2002, right? Are there any symptoms? in terms of the Shiller PE ratio. Okay, ready? Now, this is December 1999. So this is October 2002. It's a bit maybe 1 year plus ahead. 1 year plus ahead, do you see suddenly this thing spike up and reach a very sharp peak? Huh? So if you want, you can take a photo of this also. And remember, the all-time historical is about 17 on average. But this one is like so high, right? So again, there appears to be a symptom and then followed by a crash. Now, what do you think is the next crisis after the 2001 that we are familiar? The global 2008 financial crisis, right? Okay, let's look at it. So Lehman Brothers went bankrupt on the 15th of September 2008, and then after trigger off the global financial crisis. So now the question is there some symptom that took place before this 15th September 2008? Did the Shiller P ratio spike up? Now, can you see here? On the June 2007, maybe a couple of months before, do you see the Shiller P ratio? It spiked up again. And then when the recession appeared, right, the P ratio, Shiller P ratio drops. But let's look at the peak, 27.4, which is above the all-time historical average of 17. So 27 is higher than 17. Yeah. So three evidence. But let's look at today. So what are we looking at today? Where are we today? How can a S&P 500 shoot up, right, when companies are not doing well? I mean, of course, other than Amazon and all that. Ready, huh? Where are we? Before the Great Depression, a quick recap, right? Shiller P ratio 32.6. Before the dot-com bubble, 44.2. All above the all-time historical average of 17. Before global financial crisis, right, 27.4. So where are we? Do you realize that where are we today? It appears to be higher than before the global financial crisis. Now, if you want, can you please take a photo of this? This is what I'm trying to tell some of my friends, that I'm just guessing, I'm just foreseeing. Perhaps, maybe months down the road, 1 year down the road, there may be a second collapse. Now, but let me just highlight something. This kind of correlation based on science is circumstantial. It's not a cause and an effect. So what do you mean it's not a cause and effect? What do you mean by circumstantial? So in other words, every time when there's a recession, it happens that before the recession, the Shiller PE ratio went what? Up. But it doesn't mean that when the Shiller PE ratio go up, it will cause a crash. You get what I mean? Shiller PE ratio does not cause the crash. But strangely, before the crash, somehow, for some reason, the Shiller PE ratio always go what? Up. So perhaps we can use this as an indicator, plus the rising case of the active cases, plus the rising death cases, to make some guess that perhaps there will be a second dip.